Hi, everyone. Thanks so much for joining. Can you believe it? Another month has passed. Well, not quite, because we've obviously got payrolls on a Thursday today instead of a Friday. I hope that hasn't knocked you out a little bit, but it's because of the Independence Day holiday in the US. So let's kind of get down to business, because the main event is obviously the payrolls number. So the headline figure that's expected is 114,000, but obviously it's not always just the payrolls that is key. So we've also got average hourly earnings. That's expected to tick just a notch higher to 3.5% from 3.4% for June. We've also got the unemployment rate, which is expected to come in at 4.3%. So yes, by and large, most of analyst estimates are between that kind of late 90s to 120 mark. In fact, FX Street are looking at 110. Reuters are predicting 114. So quite a tight little pack there about what to expect. But the one thing that I think is really, really important is as we lead up to this, the real question is, what does this mean for interest rates? Now, two interesting things have happened this week. We had the Kevin Walsh speak at the ECB conference. That came out, and he was actually pretty sanguine about the outlook, maybe slightly less hawkish, but that hasn't had an impact on interest rate expectations in the UK, in the US. We've still got a very high chance of one rate hike by October and a 40% chance of another hike before the end of the year. So still pricing in around about 2 hikes, although today's data could change that. Complicating the picture a little bit further, Kevin Walsh doesn't like forward guidance. Well, it turns out he doesn't really like payrolls either. He was quite critical about some of the economic data that is looked at very, very closely by markets. So just adds a whole nother line. Now, let's take a look at the charts quickly before the number comes out in 4 minutes. This is the dollar index. As you can see, this is a 3-month chart. Dollar index just marching higher. It's pulled back a bit today, but it is close to a 14-month high as we lead into this payroll. So we've seen higher yields in the past kind of month, well, in the past 3 months, and also a stronger dollar. So the dollar is very, very strong. It's pulled back today, and that's largely because of what's been happening with dollar yen. I'm going to just take a quick look at dollar yen for you. This is our X Station platform, as you can see, and we'll take a quick look at dollar yen. Yeah, as you can see today. So this is short-term chart. We were going up. Dollar rising versus the yen. We were above that, just below that 163 level, and then all of a sudden, boom, it fell. So it dropped from 162.60 this morning all the way down to kind of just above 160, just below 161. But it's not really a massive move. There was rumors that this was intervention. Remember, the Bank of Japan, they don't like such a weak currency. This is the weakest it's been for 40 years because it puts upward pressure on inflation. So they don't like that at all. So they have been sporadically going into the currency market to try and strengthen the yen, so weaken the dollar essentially. And this is quite a mild move, if I'm completely honest. If this was intervention, I think they have to do something better than that to keep the lid on the yen, because as you can see here, it's already picking up. So if you follow my pointer there, we'd gone to 161. We're currently trading around 161.50. So we're even picking up from those potential intervention lows. So really it just shows that they will have to do more. It's been a very small intervention. The impact has been much more muted than in the past, but that definitely is something to watch. We've also had a bit of a stock market sell-off. If I just show you, I think I've got time. Yeah, we've got 2 minutes just about the Kospi. Oh, sorry. Bear with me 1 second. Always forgetting those. Let's look at the US 100, because that is another sign. The US 100 has, looking pretty busy there. But as you can see, US 100 obviously has been a little bit in the doldrums just in the short term, with the DAX and even the FTSE able to kind of extend gains there because they're not tech indices. So today, we're seeing an increase in European stocks. We're seeing a pullback across Asia, particularly South Korea, and also in those key tech names like the SK Hynix, the chip names. They are the key thing. And that's because Meta yesterday came out with some news that it was going to start selling some of its AI compute. That is worrying people that we could be at peak capex cycle, that they may not buy as many chips. Now, let's put dollar index back up so that we're ready for what comes next any second now. And we'll, bear with me, guys, and we will just keep that on. Just do the 1 day. We'll see where we're going. Yeah, as you can see, moving a bit sideways, but let's see where we are with everything. Just waiting. Now, shouldn't take too long. The anticipation is killing us. Okay, we're out. Oh my goodness. We have got non-farm payrolls much weaker than expected, 57,000. We've also got the unemployment rate has dipped though to 4.2%. So we've got these two diverging signals. We have got a slightly weaker 4-week jobless claims, 222K versus 224. Nothing too much there. And again, the average hourly earnings, they were in line with expectations at 3.5%. So that is a bit of a downside shock there. That's really interesting. One has to suggest that's why the Bank of Japan decided to intervene. And look at that. Dollar index has absolutely fallen like a stone. It's moving back towards that 100 level. Sorry, 160 it's been at. Now 100, the 100.5 level, 100.50, is a really key level of support. Once we broke above that last week, that was a really bullish development for the dollar index. So we've seen that fall off. Now, what does a weaker payrolls number mean? It means a couple of things. It means that we could see a scaling back of interest rate expectations. So certainly no rate hike, I think, expected now. I'm just going to quickly look and then I can show you guys as well. But I'm going to be pretty much expecting interest rate expectations to really scale back on any expectation of rate hikes. For July meeting, that had been about 30% ahead of this. It's not quite yet loading up. We're seeing that. We would also expect maybe this will help tech stocks to recover a little bit. In the US, there was a big semiconductor sell-off yesterday, down 6.2%. In fact, I will show you that chart. So if you just bear with me, I'll stop sharing that. And then we will come onto my new screen and we'll share that instead. There we go. As you can see here, this is the Philadelphia Semiconductor Index. That was down 6.2% just yesterday. Let's have a look. There you go, 6.2% on Wednesday. But over the past month, it has done pretty well. It's up 5%, but on a year-to-date basis is up 83%. So it's done very, very well. But there has been some pulling back of those semiconductor names because of what's been going on with Meta, with them scaling back some of their AI ambitions, leading to a few fears about whether or not we're at peak capex. But if we look at the components here, you'll see what was driving that decline. But as you can see, 11% decline in KLA. All of these, Micron down 10%, Applied Materials down nearly 10% as well yesterday. Intel down 9%. Remember, these are some of the names, the Intels, the Marvels, the Microns. They have just contributed so much. In fact, their market caps have gone up by $2 trillion in Q2. So it's no wonder that anything that disrupts the AI narrative and the AI infrastructure build out will have an impact then on the semiconductor names because they're so important. They're what's powering the AI infrastructure build out. But if we just look at Meta, because Meta was a real winner yesterday, up over 10%, had a fantastic day. The market really liked what it was hearing, and it's not giving much back in the pre-market. Today in the pre-market, it is down just 1.3% after rising 8% yesterday. So we would expect that bit of a pullback, but a fantastic recovery in Meta, suggesting that maybe the market quite likes them scaling back a little bit of maybe their capex spending. But I think that is something that's definitely worth watching. I'm also going to show us, let's take a look at some bond yields, because bond yields are obviously incredibly sensitive to this as well. We have got, just bear with me 1 second. There we go. Now you should be able to see bond yields. These are UK yields actually, just to show you kind of what they've been doing, but we've seen a big decline across the curve in the US. So 2-year yields now down 6 basis points. Obviously not so much at the long end. We've got steepening of the yield curve again. So that's when lower, shorter term bond yields fall and longer term bond yields rise. So it kind of causes a steepening effect. That's kind of the real key thing. Also, with that drop in the dollar, we would expect gold to do really well. Let's just take a quick look at gold. Yeah, gold is up 0.8%. If we just take a look at the gold chart, we are back above 4,000. Obviously, it has been a bit of a torrid time for the gold price, but we are back above that 4,000 level. We're up 0.8% today, so we're currently trading at 4,065. So that decline in the dollar really helping to benefit, and that decline in yields helping to benefit the gold price, which could extend gains. We've also got a much weaker oil price today as well. That's because if we just look there, crude oil down 1.3% as well. Now this is obviously WTI. This is down below $68 per barrel, so that is certainly something to watch. Brent crude is just getting towards that $70 a barrel. Remember, it tends to be a little bit higher, but as you can see, nice decline. That decline very much looks like it's in place. There were apparently a good outcome from the talks in Qatar between Iran and the US. They went well. That is really helping sentiment overall, but it's certainly boosting sentiment to European stocks because of this decline in WTI and in crude prices. So this is something not directly to do with the payrolls number, obviously, but what it does do, a weaker oil price combined with lower payrolls does help in some way to certainly reduce the chance of rate hike expectations. Now, just bear with me, guys. I'm just going to try and find out what exactly is going on and where the job losses, where the jobs were gained from. Remember, that's kind of just as important, really. We have seen a 57, that's actually below 57,000 reading is actually below the average for the last 12 months, which has been above 80. So there was really taking the market by surprise here, because we were not expecting that to happen in any way, shape or form. And if we look at where the jobs are coming from, let's take a look just to see if it's a one-off factor. Now, we did have excess hiring last month. Remember, if you remember, in May, we saw 172,000 jobs created. So this is quite the reversal. The unemployment rate 4.2%, that was a little changed. Yeah, it's just dropped a bit. The major worker group showed little or no change in June. That was on the household survey. But in the establishment survey, this is what creates the payrolls. We had we saw an increase in professional and business services. Now, we had actually reported that already because we had seen and had noted that companies that were expanding AI were actually expanding headcount. So that's really interesting because that's played out there. They trended up in June. Social care, they grew as well. That's been a really outstanding. Healthcare has been really, really outstanding in terms of job growth, but the BLS does note that it grew at a slower pace than average. For June, leisure and hospitality, very strangely, those jobs declined by 61,000 in June, which reflects weaker than usual seasonal hiring, which is really interesting considering you've got record attendance at the stadiums around the US for the World Cup. So that's something to kind of keep an eye on. Actually, that might be revised higher. Now, because of all these revisions, of course, you could see why the Fed doesn't really like it. But overall, yes, that's unusual, but leisure and hospitality hasn't picked up. But actually, that had been one of the building blocks of payrolls in recent months. So the fact that that has seen a decline in unemployment of employment of jobs by 61,000, that leisure and hospitality shedding jobs is definitely something to watch for. We've also got, pay growth has increased by 3.5%. So that is above the Fed's 2% target rate, but I don't think it's too inflationary with everything else that's going on. And again, the fact that the labour market, we've got two diverging signals, which I think is really quite interesting. If we just go back home there, we can see what's going on with the FX crosses. So yeah, we're seeing a real pickup now in the euro, in the British pound, the yen. These are the dollar FX pairs. If we look at the yen, obviously that is still, the yen is down again. So that's kind of extending its downside. Yeah, down more than 1% today, the yen. We've also got some gains for the euro, 0.7% gain for the euro, 0.7% gain for the pound. Dollar is just weakening broadly. So it really, really is selling off. And that is definitely something to watch. But it's also a bit of relief, I think, for certainly the Japanese authorities, certainly for bond yields. It just by having a weaker payrolls report really changes the dynamic now for the Fed and really challenges that strong dollar narrative. If we just look, again, it's a little bit early to see exactly how interest rate futures markets are reacting to this. I think it's going to take a little while, but I think that any prospect of a rate hike for July now is priced out. I really do. And I think if anything, the markets might just kind of reduce things generally. So maybe instead of 2 hikes, there might just be 1 priced in. But overall, guys, thank you so much for joining. Never a dull moment when it comes to payrolls, right? We're always looking, always something to report on. Last month, it was a much bigger surprise. This month is weaker. All down to those leisure and hospitality jobs. Where are all those, people working at the stadiums? I don't know. I'm a little bit skeptical of this report, but it is certainly weighing on the euro, definitely benefiting the Bank of Japan. And in fact, I should have made that link earlier, actually, that would the Bank of Japan really intervened to stem yen weakness? If they'd honestly thought that the payrolls were going to be stronger. Who knows what's going on there, but it is quite an interesting dynamic. So on the back of payrolls, we've got weaker yields and also weaker dollar. So that is the narrative now as we move into the last the start of the third quarter of the year. Okay, enjoy everyone. Thanks so much for joining.